Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, and still is I suppose, after a fashion, the breached and now seemingly repaired dark blue September to December 2024 bear channel, currently 17.5 to 2032. This pattern achieved its primary downside target mid-January and its secondary hard-to-reach target about a week after the primary target. Interestingly, the move down to the secondary target and back up again formed another new pattern, one which I will discuss shortly. However, before that, I'd like to highlight again another larger, longer-term pattern, and that's the bright green breach, November 23 to September 24 bearish Andrews pitchfork. This pattern, as I said, had been breached and is still breached today, but prices are riding along the top of the breached upper tine, I should say, currently at 1936, so close that a repair might still be affected, or at least the upper tine might be influencing the market's actions. Hence, I'm leaving this bright green upper tine where it is. However, I was and I still am considering finessing this into a shallower bearish shift pitchfork, and maybe even at some point retiring it completely. I have another pattern which I would like to discuss, and maybe another to think about. The pattern to discuss is the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 3 weeks ago, to try and help make some sense of the recent moves. We are today still in between the middle tine below, currently at 1815, and the upper tine above, currently at 2071. Elsewhere today we are a little above the green short medium moving average, currently at 1938, which is reinforcing the bright green upper tine. At the same time, overhead we have the flatlining gold long moving average, currently 2007, which capped all of last week's prices, along with the March 2023 low at 2004. This is about to be reinforced and I suppose eventually overrun by the declining mauve medium moving average from above, currently at 2011. Now, on a cursory inspection, it seems the mauve medium moving average has been the better of these two as an overhead resistance. This leaves the possibility to still think about looking at the mid-January to early March action as a possible bullish Andrews or bullish shift pitchfork. For at least a second week, I haven't done much more than contemplate this as an idea right now, and it has all the issues of being part of a continuous daily chart and clogging up my daily chart with yet more lines that I already possess. However, it remains, how did I put it before? It remains on my radar. To counter this, I'll reprise part of my commentary from 2 weeks ago when I said, and I quote, "So in an effort to get a handle on what further technicals were operating here, I went back to my annual commentary last week and looked at the monthly charts there, and I saw that the bright green Andrews pitchfork, despite the breached topside, is still the dominating pattern, along with a double top, an Adam and Eve type that had been constructed throughout 2023, which had already reached the primary target at 1880, leaving live a still as yet unfulfilled harder to reach secondary target down at 1630. This longer term pattern is the one I choose to watch, and I'll see how it develops." End of quote. I added last week, and I quote, "These bearish ideas are becoming more and more eroded." End of quote. This week, well, they may appear so to be more and more eroded, but I'm starting to suspect a change may be about to start. Ice Europe white sugar in London. There continues to be 3 features to bear in mind here on this daily chart. The first is the obvious purple late September to date descending expanding wedge pattern, currently 404.70 to 530.70. This pattern has more than the requisite 5+ touches and was severely tested on the top side over late February through into the start of March, when prices dropped back within the pattern. However, 2 weeks ago, the market pushed up over the purple upper trend line and even gapped higher a week ago, threatening and briefly breaching the high made back in late February at the February 2017 high at 565 even. However, the market has not stabilized over this February 2017 high, closing once on it and never over it. We've since dropped back down today just within the breached and possibly repaired again purple descending expanding wedge pattern. Now the second is the January 2024 to date downtrend, currently at 565.10, highlighted in bright red on my daily chart. It had effectively capped earlier rises since its start, most recently in late February, but last week was breached, enough that I have today chosen to realign it to include last week's highs. The third is the flatlining gold long moving average, currently at 541.60. This had previously helped cap prices, but last week saw a gapping move over it. I said last week, and I quote, "Unless the market turns and rapidly, then I will pare down its importance." End of quote. Well, we've seen that turn down and the gap being filled in today. Okay, so I'd now like to run through some new features and a potential pattern that I introduced last week. The first feature is to lay out some potentials for a move up and out of the purple descending wedge pattern. I said last week that, and I quote, "These may be a bit premature, but I'd rather lay these out now than later." End of quote. Thus the primary topside target X is in the 650.10 area, the secondary hard to reach target X1 up in the 673.80 area. Next is to view the whole late January to date action as a possible bullish halfway hesitation. I did last week and I quote, "If this becomes the case, and we'll have to see how prices perform over the February 2017 high, then we can start viewing the primary target X2 up in the 605 area." End of quote. Well, and especially considering today's actions, since then I am on the verge of retiring this idea completely. It's only because the market is within just about the final and only bullish pattern I've drawn on my daily chart, and that's the bright green mid-January to early March bullish Andrews picture, that I've kept this idea still on my list and not retired it. If we look at this final pattern, we can see the bullish bright green pitchfork is having its lower time, currently at 544.40, being tested today. I am, as I said last week on this pattern, I quote, "quite prepared to finesse it into a shallower bullish shift pitchfork at the same period if needed." This is the first bullish pattern, apart from I suppose the reverse head and shoulders pattern, that I have drawn here for quite a while. I'm not sure of it, but with prices rallying and pushing out through significant resistances, it's time I looked on the upside here. I suppose a lot now depends on what the market does, its actions and also its reactions around the February 2017 high at 565 even. End of quote. We can see that 565 even area overhead has become quite crucial for a lot of things. Sugar white premium spread. An interesting pattern last week after the previous week's weekly holding pattern, and it's based on the support of the 1 year moving average below, currently at 110 even. It was a possible shooting star pattern close to a bearish gravestone doji, usually seen as a bearish pattern, though it was also close enough to being an indecisive doji cross with a very long tongue on it. What it also has shown is the market's reluctance to test up towards a significant combined 50% Fibonacci lines overhead of the July 2019 to September 22 move at 128.75 and the August 21 to September 22 move at 131.25, plus the June 2020 high at 134.25. However, overall, the recent action can still be seen as a continuation of the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. 3 weeks ago, we had the combination of a hanging man pattern, but also a bearish engulfing pattern and a weekly key reversal down. This tempered the recent rally and has made the market look down from its heights ever since. Despite the recent nascent bearishness, I've decided to still leave potentials for the original large descending wedge pattern seen throughout 2024 still on my daily chart, for now at least. And that's of a primary target X up at 137.5, which is above the immediate overhead resistances, and a secondary harder to reach target X1 up in the 154.5 area. So are these targets achievable? Well, yes. But there is a very large question mark hovering over all of this, due to the overhead combination of the previously mentioned 50% Fibonacci lines, plus the June 2020 high, and a congestion area. We have overhead between 128 3/4 all the way up to 153 even, which will make target X perhaps hard, and target X1 further up just that much more difficult. Today we are, well, virtually unchanged to possibly maybe a little bit higher, lower. And it seems once again, as I said last week, and I quote, the market has not taken the bullish incentive by the horns. Sorry for the mixed metaphor here. We've not pushed just that far high enough as yet, end of quote. I also pointed out 2 weeks ago, and I quote, apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone, end of quote.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.